Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over something that I see a lot of people ask about. People are constantly talking about this stock right here, SPHD, or the High Dividend Low Volatility ETF that pays monthly by Invesco. It has a growing dividend, it has a 6.3% dividend yield, an expense ratio of 0.3%, and I feel like all the time in the YouTube comment section, people making videos about it, this is the one that people like to recommend when they talk about monthly dividend stocks. This does pay a monthly dividend, which is very rare among most stocks. It is an ETF, meaning that it holds multiple stocks in its portfolio and it pays you out monthly. Now, the reason why I don't like this stock, I'm going to be breaking this down in the video, and those of you that are interested in getting an update on my portfolio, I will be saving that for the end of the video, as well as giving you guys an update on my dividend income and my portfolio value on this chart example right here. And also, if you guys enjoy watching my content and you're interested in using M1 Finance, thank you guys so much, the 9 that have used my referral link. I look forward to getting more referrals from you guys watching in the future. Thank you guys so much. Maybe we'll have to start something else like a Patreon or something for you 9 guys that signed up using that referral link. Let me know down in the comment section if you're interested. But we'll give you an update on my portfolio at the end of the video, so fast forward to the end of the video if you're interested in that. But let's jump right into SPHD stock. So first off here, before we dive into any of the holdings in this stock, let's look a little bit about the performance of the stock, its dividends that it's paid out every single month. It started out paying 10 cents a month, and then it's raised to 11, and then to 12, kind of jumped around a little bit, 14, 15 or so, and now we are at 16 cents every single month. So 16 cents every single month until that's cut. And here's why this is going to be cut. I'll be going over all the stocks that are in this holdings, and there are so many stocks in this ETF, they're at a major risk. So if you look here, its two biggest holdings are the Williams Company and Gilead Sciences. Not too bad there. Gilead Sciences, they are a very stable, safe company. There's 51 holdings in the portfolio. All of it is just domestic United States stock. There's hardly any in non-US stock and any foreign stocks. But what I wanted to do here is I want to click the research tab and I want to click funds. And I think a lot of times people get caught up in this thing where they focus too much on the dividend yield. And I saw someone the other day commented in my YouTube section, they were asking me to review their portfolio and they had a dividend stock that was paying something astronomically high, like 40, 50%. So let's look at some of the highest paying dividend stocks that M1 Finance has to offer. So if you look here, 106% dividend yield. Now first off, if you were brand new to the stock market, if you're watching this, if you're brand new, you're trying to find monthly dividend stocks, you see this number and it doesn't tell you the whole story. You see this and you think, oh my God, it's going to pay me 106% every single year. So let's look at the 5-year performance. Down 93%. The dividends from 10 cents every single month, and now it got cut 70% down to 3 cents. Okay, well maybe that's a fluke. Let's look at the next one. Okay, it's another energy fund. Has a 76% dividend yield, down 92% over the last 5 years. What about its dividend? Pays about 42 cents, 42, 42, and now it got cut down to 24, so almost in half. Okay, maybe that's another fluke. Let's look at the third one. Last but not least, we have Fiduciary Claymore Energy. This pays a 65% dividend yield, down 92% in 5 years. Do you guys see a pattern here? Huge dividend cut, like 90%. When you have a stock, the higher the dividend yield it is, the more it is at risk of being cut. So the other day I was recommending stocks that you guys need to purchase, and by far the most speculative and by far the highest yield that I have in my portfolio is Altria Group. Now the reason why the stock has performed poorly over the last 5 years is because they've had some issues with Juul and things like that, but their management is starting to get it under control, but they have rising dividends. I think that there's a good chance that this stock will be able to hold its portfolio. One of the stocks I just recently sold, which to me the dividend yield is too high, 8%. I think with all the economic issues going on with this bank, I think the management team is going to end up cutting the dividend. So I sold it. We'll see if I'm right or not in the next couple of weeks or couple of months. But going back to the funds here, you see a pattern here. The higher the dividend yield, the more of a chance it is to cut. So if you can see here, we're going to click equities, and then we're going to click domestic, so US, and then already, if we click large cap, one of the first stocks that shows up is SPHD. It's like the 10th one down here. But let's go to Invesco.com. Let's go to their official website. If you see here, there's a couple things I wanted to point out. The Invesco S&P 500 High Dividend Low Volatility ETF seeks investment results that generally correspond, before fees and expenses, to the price and yield of the S&P 500 Low Volatility High Dividend Index. The fund generally will invest at least 90% of its total assets in common stocks that comprise the index. Standard & Poor's compiles, maintains, and calculates the index, which is comprised of 50 securities traded on the S&P 500 index that historically have provided high dividend yields and low volatility. The fund and the index are rebalanced and reconstituted semi-annually in January and July. Now this last sentence here, that's the first thing I want to talk about. The fund and the index are rebalanced and reconstituted semi-annually. That's the key word there, semi-annually. Okay, it says right here that they rebalance it every January and every July. So what if a stock cuts its dividend in, say, February? Do you have to wait until July? Yes, because they're not even going to take a look at it and rebalance the portfolio until July. So you're holding that stock for months, for 4 or 5 months until you can get to July, and then they can drop it and pick up something else with it. So that is already one thing I don't like. You're having other people manage your money for you. Now that can be successful. There's nothing wrong with that. But I don't like to be in reliance of other people. There are 3 little sections I wanted to point out right here. These 3 are the main 3 that I wanted to focus on. Investment focused in a particular industry or sector are subject to greater risk and are more greatly impacted by market volatility than more diversified investments. This is obviously very, very common sense. As you see, like a lot of times people look at SPY, the S&P 500 ETF. It has performed 38.38% over the last 5 years compared to SPHD's negative 4.05%. So that has already given you a little bit of an idea for a portfolio that has 90% of the less holdings than the S&P 500 does. Right here it has 51 holdings, but if we type in SPY, S&P 500 has 506. So that is way more diversified and has a lot safer dividend yield. The second sentence says, securities that pay high dividends as a group can fall out of favor with the market, causing such companies to underperform companies that do not pay high dividends. Now here's another thing I wanted to point out. I'm going to give you a stock that is a very, very popular high dividend stock that a lot of people invest in, including myself. AT&T. It's traded pretty much sideways over the last 5 years. They have raised their dividend every single year. They are a dividend aristocrat. They are a very safe company in the fact that they're very consumer defensive. They have a very stable business model that is reliant on cell phones and internet connections. But this stock has a 7% dividend yield. That is part of the reason why the stock has went nowhere, why the stock price stays the same, because they pay out so much in dividends that they can't really afford to have any retained earnings to grow that share price. Now, if this stock stays flat every single year, I'm fine with that, because I have a growing dividend and a high dividend yield. I just need them to keep that dividend. But if they don't, if they end up cutting that dividend, if they can't grow revenues, AT&T is going to be in trouble. Me investing in the stock is going to be a mistake. So the same thing with SPHD. I think a lot of stocks in this portfolio are about to be cutting their dividends massively. I think this dividend of 6.3% is probably about to go to 4%, or who knows, maybe even somewhere around that. Not to mention, because these stocks will be cutting their dividend, the share price is going to fall through the floor, I think. I'll be going over that. And third, last but not least, there is no assurance that the fund will provide low volatility. So when you have a stock ETF that its name is literally Invesco S&P 500, high dividend, low volatility ETF, and they cannot guarantee that the fund will provide low volatility, what's the point? I think for a lot of times, if you're looking for a very safe, stable investment that no matter what, in any economic environment, will not go down a whole lot in price, what I would recommend doing is going to Expert Pies, General Investing, and what you need to do is click Ultra Conservative. It doesn't matter if the stock market goes up, doesn't matter if the stock market goes down. It's very slow, but your portfolio will go up every single year. 95% of the time, 1 to 5% returns every year. See here, I had a little dip from $100 down to 96. So yeah, 3%, whatever. Had a little dip. Even in that right now, in one of the largest stock market crashes in history, 111 down to 106. Ooh, 5% dip. This is what you need to invest in if you're worried about low volatility. SPHD, it's not low volatility. It's a mistake. So I don't really like this. The only thing I do like about it does pay monthly, but it's not worth it. And then what you all came for, let's start breaking down the holdings of this portfolio. Let's start looking at all the issues that I have here. We click Top Holdings, we click View All, and then you can see here right away it's sorted by sector, and I can already see some issues here. So the number one holding in real estate, Iron Mountain. Iron Mountain is kind of in a weird spot right now. They are at risk to cut their dividend. They are down 35% over the last 5 years. Now, first off, they have a 10.3% dividend yield. That's already a red flag. They have a business model that's currently in the process of trying to change because a lot of their revenue comes from very sticky customers from a lot of people that have paperwork stored inside of office buildings. That's where Iron Mountain comes into play. This is where they get the revenue, but as people are switching to more and more data centers and less paperwork, Iron Mountain is the one to lose from all of that. So we already have the first one already at risk. I won't be diving in deep to every single one of these. A lot of them I don't know, a lot of them I do. But there's a lot of risk with all of these. So just go over quickly, very quickly. VTR. VTR is a REIT that has had a lot of issues. They are a healthcare REIT, and we all know with the illness that has taken place, Ventus is at a huge risk to cut their dividend. Look at the drop in share price from $60+ down to 20, so about a 2/3 drop there. Public Storage, that's a company I like. That is a company that I actually made a video about a couple weeks ago that I was considering adding. Kimco, I don't really know a whole lot about. I know they're another REIT. Now, I don't know this company specifically, but I already know that the hospitality sector has went to the floor. You see companies that are cruise ships like CCL and Norwegian Cruise Lines, and you see a lot of other hotel operators and things in that area. Anything with hospitality is at a huge risk for cutting dividends. I think it is very likely that this one will as well. Don't know that company. Health Peak Properties, this is pretty much the same as Ventus. It is another healthcare REIT. I think they're at a huge risk of cutting as well. Welltower. Welltower, I'm actually not sure. I thought they might have already cut their dividend. But Welltower is another one that is at a huge risk of cutting their dividend. They are another healthcare REIT. Simon Property Group. Simon Property Group is one of the better run REITs in my opinion. SPG is their ticker symbol, but they are the world's largest REIT for shopping malls. And you can see how this has went for them over the last 5 years. They're down 69.69%, have a 15% dividend yield, but they already cut their dividend. Simon Property Group, they have no chance really of keeping their dividend, not anytime soon. I'm sure they'll eventually pay a dividend once we get back on our feet, a very small dividend, but this stock is not going to be able to hold and maintain a 15% dividend yield. It's just not going to happen. And then last but not least, I do not know this one. This is Vornado Realty Trust. You can look into that if you're interested. Now let's look at utilities. I like a little bit more some of the utility sector that they have. Dominion Energy, one of my holdings, very good. Duke Energy, another one that I considered adding, very good. PPL, I have heard a lot of people talk about this one. This is one that I don't know a whole lot about. I know they are a lot higher yield when it comes to utility stocks, 6.4%, but utilities are a very need-based company, so I'm sure this one is okay. The next we have Southern Company, one of the largest stocks in my portfolio. I love the Southern Company. It's a great buy there. Do not know this one. Do not know this one. Consolidated Edison is a very stable, safe dividend company. Now, I do know they have been at a little bit higher risk of a dividend cut because their dividend has gotten a little out of control compared to what it usually is at. They are a dividend aristocrat, so I don't think they're going to be at any risk to cut their dividend there, but we'll see where that goes. And then last is Edison International. I believe that's just the international version of ED, Consolidated Edison, so I'm sure that one is fine as well. And then let's get into consumer staples. So first we have Altria Group. I just mentioned this, MO, one of the stocks I own. Now, I will tell you, even though I do love this stock, I do love the dividend yield, I think if I had to bet one way or the other, they'll keep the dividend, but I do know that they are at a high risk of cutting it. If I had to pick one stock in the portfolio that would cut their dividend, this would be one of the number one contenders. It is a risk. The same thing for Philip Morris. Basically the exact same business model. MO, Altria Group, they sell cigarettes. Philip Morris, they pretty much do the exact same thing. They sell tobacco and cigarettes. Another very high dividend yield of 6.6%. The only reason MO, Altria, is down more is because, like I said, the stake in Juul that went wrong. But let's look at the next stock. The next one that we have is General Mills. General Mills has had a lot of issues, a lot like you see KHC, Kraft Heinz. Kraft Heinz is a boxed food company, and they've had to cut their dividend, and they are at major risk of doing it again. And when we look at General Mills, we might see another scenario like that, but I think this stock will be able to cut its dividend. I'm not really against that. I think that's a good buy for SPHD stock. Next is JM Smucker. Same thing with General Mills. It's a food company. A lot of people are loyal to that brand, and Kellogg is pretty much the exact same thing. TAP, TAP, Molson Coors Beverage Company. Now, we'll say with TAP, TAP has had a lot of issues like most beverage companies that serve beer and alcohol products. A lot of these major alcohol companies, the millennials hate beer. Now, I'm speaking macroeconomically. I'm not talking about me or my friend or the people I know. Generally speaking, a lot of these beer companies are switching more and more to hard seltzers and hard lemonade and mixed fruity drinks because people don't drink beer anymore. It is a declining sector. So a lot of these beer companies, as you can see, have been hit very hard from this. I don't know if they'll be able to keep their dividend, especially in a time like now. I guess we'll see. As I know a lot of restaurants that serve beer like bars, I know most of those are closed down, so who knows if Molson Coors will be able to keep that dividend. There's definitely some risk there with a 6% dividend yield, and they're down again on the day. The market just opened, by the way. The next we have financials. We have Progressive Corp. That is a insurance company that is a very safe dividend yield. That is a very low dividend yield as well. I'm kind of surprised that it's even in the portfolio because it is such a low dividend. It is only 0.5%, but that's a great buy there. I'm not against it, but it is a low dividend yield. People's United Financial, I don't know that one. I do not know this one. Do not know this one. Actually, okay, as I look through it, this is kind of crazy. I actually only know two in this list very well to actually give an opinion on it. So Wells Fargo, I just gave you guys my opinion on Wells Fargo. I just made an entire video about why I'm selling it. And if you own Wells Fargo, I think you should consider selling it as well, especially if you're a dividend investor. If you're a share price investor, if you're looking for growth, I think there are still so many other opportunities out there. And I think Wells Fargo will probably stay down for a little while. This is what I'm talking about when I'm talking about chasing yield. I think what I let happen to me, I own two bank stocks. I own this and I own JP Morgan. JP Morgan is one of the better banks out there. It is the largest bank in the world, I believe. I believe they're number one. But Wells Fargo, I think they're number fourth largest in the world. They have had a lot of financial and management issues, you all know, with the recent scandals that happened a couple of years ago. But not just that, I think getting themselves so high leverage between a massive dividend raise and then share buybacks as well, I think I let this high dividend yield manipulate me into overlooking all the issues they had, and I made a mistake and I sold it. It's okay. It's in the rearview mirror. We forgot about it. Don't buy Wells Fargo. So that is one that I know right there that is already at risk of cutting its dividend. And I know just generally speaking with the financial sector, a lot of financial companies, a lot of banks, stuff like that, are at major risk of cutting their dividend because lending right now, it's crazy. It's never been like this in the history of America. And then let's get into the energy sector. Now, first off, of these five companies, I am relatively familiar with four of them, especially these three right here, Chevron, Exxon, and one OK. I made an entire video dedicated to energy companies where I broke down three companies. I broke down Chesapeake Energy, I broke down Exxon Mobil, and I broke down Chevron. Now these two I do not know very well. Kinder Morgan I've heard a little bit about. I haven't really researched it and dove into it. Like I said, I don't really keep up all that much with dividend companies. Now I can probably tell you, before I even hit enter button, I'm going to guess that this dividend yield is probably over 5%. Yep, okay, 6.51%. I figured they're down 64% on the year. Let's see if they cut their dividend. No, they have not. Who knows if they'll keep it or not? I guess we'll see. But going to the other companies, I went over Exxon, Chevron. If we look at Exxon Mobil here, they have a 7.8% dividend yield. Red flag. They're down almost cut in half in the last 5 years. We know that the energy sector, just generally speaking, has done very poorly since this recession. I know we've had things like negative oil prices, and actually one of the things I wanted to point out here, One OK is actually a company that is in my state that stands for One Oklahoma. So I'm actually from Oklahoma, so I've had some familiarity with this company. I think that all these companies are at a major risk, including these two big dogs right here. I think all five of these companies are at a major risk of cutting their dividend. So let's get the communication services. AT&T, I just went over that. It's the only two of the stocks in these 4 or 5 that I own. I think Verizon is at less of a risk to cut its dividend compared to its competitor AT&T, but I do think it is safe, and it is still a little bit on the edge, but I think they're for the most part safe. I think AT&T, they do have a risk to cut their dividend. I think they will keep it just because management is so focused on keeping it. I'm not familiar with this one, Interpublic Group. And then let's get into healthcare. We have Gilead Sciences and Pfizer. So I want to point out a stock that is not on this list. One of the stocks that I see people talk about all the time for dividend investors is AbbVie. Now, people always talk about only invest in what you understand. AbbVie is more than likely a very safe, stable dividend company. The thing is, I do not understand it. I do not know enough about the business model. I know that they have a drug, Humira was their big money maker for a long time. That's fine. I'm sure that this company, very similar to a Pfizer, for example, I believe that they'll probably keep their dividend just from what I've heard about them and just getting a little bit familiar with these drug companies. That said, I don't feel very comfortable with anything that is primarily drug or pharmaceutical related for the most part. If I am going to invest in a healthcare company like Johnson & Johnson, one of the ones I own, it has to be a very large dominant player with a very safe investment grade dividend. So Pfizer, I'm sure is very safe. I could be wrong. I don't know this one very well, but it's a lot like AbbVie. I see people recommend this one to me all the time. I just don't know enough about it. I don't feel comfortable investing in it. And if you see here, I'm sure Pfizer is going to be safe, but I do know Gilead Sciences is once again the same thing, another lot larger pharmaceutical company. I'm sure that these are probably safer than Pfizer and AbbVie put together. I'm not sure. You can look into that. International Paper Company on the materials section, IP. So first off, I have not really done a whole lot of research into this company, but I have looked it up before. 6.15% dividend yield. They're down a little bit on the day, and you can see they're down 38.59%. Now their dividend has grown quite significantly, and this is one thing before I even researched anything about this company, International Paper Company. People are going more and more online. Now, we just talked about Iron Mountain, IRM. How they make their money is people store their paperwork in their facilities and they have sticky customers that they keep for years. Well, people are transferring all that paperwork into online resources. I'm sure that a similar scenario is happening to a company like IP, International Paper Company. I could be wrong. You need to do more research into this company if you're interested, but that is something that you need to think about. Obviously, just seeing the name of this company already raises a red flag, as well as the high dividend. I'm sure if I were to look this up, the payout ratio is probably going to be very high on a company like this. It is at major risk in a time like now. I'm not familiar with this company. General Motors. So I brought up General Motors several times in all of my videos. A lot of times when I compare a company like Tesla versus General Motors, this reminds me of a Ford play, except General Motors is a little bit well run. So Ford, for example, over the last 5 years is down 63.86%, and they did just cut their dividend to zero. They had a 100% dividend cut, so that dividend yield of 10.6% isn't even right. They haven't updated it yet. It is zero. Ford has no dividend, and General Motors might be following in the same suit. They've had declining sales. They have a lot of issues adapting to the new market with the electric vehicle space. And Tesla is the one that I like to compare it to. They're the ones that are investing in the future. They're the one focusing long term. This is a stock that I'm waiting for it to come back down because it is the only stock that I'm considering adding this portfolio that does not have a dividend. I think General Motors is going to get overrun by a Tesla company. I think that they have not adapted very well. I think that this company has such a large imprint on the economy and has such a long, dominant name that they'll probably be able to survive. I don't think they'll be going bankrupt. But in a time like now, in a recession when nobody is buying vehicles, I think the dividend here is definitely at a risk at almost 6%. I guess we'll see. Next, we have H&R Block. So tax preparation services. This is a little interesting, and I'm kind of in between, kind of indifferent. And when we talk about tax preparation services, so H&R Block, for me, I use TurboTax, and a lot of people like to use a free online service to file their taxes. That said, I'm a very basic, single, 21-year-old male that basically just has their stock sales and then some W-2s to file. It is very simple. It is not very hard. But for a lot of people, especially large businesses and business owners, I think that H&R Block is a necessity, and they would pay any amount of money just to have the hassle of filing their taxes. Just hand it off to someone, pay their fee, and get it over with, and you can get your refund or pay your fees, whatever. I think that to some extent this is a necessity, but it does have a high dividend yield. I'm not really too sure there. You can look more into it if you're interested. And then we also have UPS. So UPS does have a very, very high dividend yield that I think is safe. I really like this one. I thought about adding this company to my portfolio. It has pretty much traded flat because they have almost no revenue growth. This is the one thing that a lot of people don't like about them, is that they're so large and they are so competitive compared to FedEx and Amazon recently announcing its own delivery services. I think that it does have a large risk here, talking about Amazon coming and eating their lunch. Amazon just sends a chill up anyone's spine who has a threat to its business model, because when Amazon enters your space, you're gone. That's just the way it works when it talks about Whole Foods, when it talks about e-commerce. They just find a way to dominate any and every market that they come into, and I think UPS definitely has some risk here, and they have almost no revenue growth due to all that competitive spacing there with all the other companies competing as well. But I think this one is safe for now, but it is a little fishy long term, and I guess we'll see. Then we have 3M. 3M Company is a very high yield stock. It is one of the largest holdings in my portfolio. I think this one's very safe. They are a dividend king. I believe they raised it 62 years, 63 years off the top of my head. They have a 4% dividend yield. I love this one. I own this one. They are at a low share price, and I love that because I think long term this stock is going to get well over $250 a share. I'm sure 5-10 years from now I'll see a double up from their share price. So Who knows? And then last but not least, we have information technology, IBM, International Business Machines. This is one of the holdings in my portfolio. I believe they're 4%. They have a 5.44% dividend yield. They have a growing dividend. They are a dividend aristocrat. They raise their dividend every single year, including this one. They just had another small raise. I think that this stock will be able to hold its dividend due to their recent acquisition of Red Hat and them changing their business model and making things more profitable and focusing less on share buybacks and more on their dividend and paying down their large debt. I do think that this stock is able to keep their dividend, but even in a stock like this, one of the ones I own, I understand the risk. I think that the stock has a risk to cut its dividend. But overall, guys, that broke down the whole portfolio of SPHD. You see how many risks there is here. You see how many stocks are on the verge of cutting their dividend or already have cut their dividend. So I think holding this stock just for the 6% dividend yield and the monthly payout, I don't like it. I think that if you want to have a dividend ETF, if you don't like picking individual stocks, you need to own one of these two. You need to own the SPY, which is the S&P 500 ETF, or you need to earn virtually its little brother. You need to own Vanguard S&P 500 ETF, which is VOO, which is basically the same thing but with the lower expense ratio. Vanguard has very, very, very good ETFs, arguably the best. In my opinion, they are the best. And Invesco, generally speaking, not just with SPHD, but just with all of their ETFs, they're horrible. I don't like them. Most of them are very on edge, very risky. And as you can see, Invesco as a company, if you do research into them, they have done so bad over the last decade. I think that this company is definitely going to run into a lot of issues over the coming years, and I guess we'll see from that. If you're interested in owning a dividend ETF, own VOO or SPY. Don't look at owning SPHD just because they pay monthly. That does not mean that the stock is any better, any more healthy. You can still get a lot of compound growth, and we can see here that the market is finally opening. If you watch my video all the way to the end, I'm going to be giving you a quick update on my portfolio. Some of the top performing stocks in the portfolio, Foot Locker is having a big red day. We have Whirlpool now being the #1 leader. We saw some top stocks right here. The last three that are on the bottom are the only three in the red. Caterpillar, we're back in the red on. Procter & Gamble, we're in the red 2%. Verizon, we're down 2%. And we are still up on 28 of the 31 stocks. And as you can see here, my top holdings are still doing very well. Southern Company is the only one we're about break even on. And in total, we are up 11.92%, or $198 worth of gains, 186 coming from market gain, and 12 coming from earned dividends. Thank you guys so much for watching all the way to the end. If you want to get a look at my dividend income, I did update you guys in my last two previous videos, but you can get a look at it there. You can pause the video if you're interested in looking over these numbers. This is my companies that I own and what they pay me annually based on the number of shares that I own. And then right here, if you're interested in using M1 Finance and you like watching my content, you want to support my channel, use this link down below. It's in the description of all of my videos. Thank you guys so much for watching. Make sure to leave a comment down below what you thought about this video if you're interested in buying SPHD stock, and I will catch you next time.